Hey everyone, welcome to another edition of the Buddy Study Group. And I decided that because we had so much fun doing this last year, because I got some really good feedback around these sessions, I'm going to bring back our study hall series on the study group. And for those uninitiated, this is really just a good opportunity for us to dive into one specific product type and just do a quick overview of the appeal, sales ideas, good candidates for the products, and review some of the recent updates, review some of the major players in the market. And after we do that review, I'm hoping this is something that we can kind of have as an open forum and really throughout so that we can help each other learn. If one person can pick up one thing from today's call, I think that's a great thing. So if you have any personal preferences, things that you've come across, any questions that you have about a particular product, definitely feel free to drop it in the chat. We'll make this kind of dynamic. But today is just to keep the name short, hybrid long-term care. And, I'm saying that with kind of bated breath because the nomenclature in our industry is just tough, right? So, what I'm talking about specifically are life long-term care hybrid plans that have extension of benefits riders. Okay. So, yes, there are other hybrid life long-term care that are acceleration products. We won't be going over those today, but you may refer to these products as linked benefit. You may refer to these products as asset-based long-term care. There's about 1 billion names for these types of products, but hopefully the definition helps you understand what we're going to be talking about today. So why don't we just dive right into it? So the appeal to me of hybrid long-term care, just at a high level, is innovation, competition, and flexibility. I think those are kind of the three main descriptive words that come to mind when I talk about these products. So, innovation, I think we see that hybrid long term care carriers tend to be the first mover on a lot of things or tend to provide us the first instance of certain types of benefits that we see. So, for example, certain things like retroactive elimination period payback, which we're starting to see more of, started in hybrid long-term care with Nationwide. We're seeing it spread to carriers like Securian and so on. Um, even seeing separately identifiable long-term care premiums to work some tax deductibility in. Um, International benefits. I see hybrid carriers really leading the way on international benefits far and away. Um, and a lot of these benefits, even being the leaders in cash indemnity, not everything I mentioned there is innovation, but I think just kind of being on the cutting edge of what's offered in a long-term care plan. I think that really rests with the hybrid market today. And I think even though there's a lot of these cutting edge benefits, right? I think a lot of these products are built very, very similarly. That a lot of them look very similar to each other. Obviously, it kind of all really got started with products like MoneyGuard that are still around today, but products like Genworth's TLC, some of these products were the earliest hybrid plans, and a lot of the plans that we've seen enter the market from that time look very similar and are structured in a very similar way. A 2 or 3 year base plan with anywhere from, around 2 to 4 year extension of benefits rider. The live, die, or quit story that everybody knows, right? That most of us are using in some way, shape, or form to really simply explain these products. They all are kind of structured very similarly. And because of that, um, I see competition happening a lot in this market and generally in a couple of main areas. So, one of the areas being those really kind of cutting edge client centric benefits to stand out when we're comparing on benefits, but of course also pricing. Uh, Pricing in the hybrid long-term care market is hugely competitive. And I don't think there is another market in the long-term care space right now where I have seen carriers repricing their product downward or carriers coming out with um, all of these extra benefits on their plan and not repricing upward. So there's a lot of competition for market share in the hybrid long-term care market. And generally, the ways these carriers like to do it is offering, um, creatively richer benefits or trying to be one of the cheapest games in town, right? How can I stand out on a spreadsheet when there's 12 other carriers in the market that I'm competing with, right? And that competition really benefits consumers. So there's a ton of action in this market. There always seems to be. And when there is that action, when there is that competition, when carriers are trying to stand out, generally that is in a way that benefits clients. Okay, so um, that's what I'm seeing in this market. Again, flexibility is huge. Cash indemnity benefits, international benefits. I think the hybrid market is all about flexibility, even in the innate nature of the product structure, right? Life insurance is there if you don't need long-term care. The products are very long-term care forward in nature because of how they're structured and the opportunity to, surrender the contract and get some amount of your money back. Flexibility with how the premiums are paid, right? We see single premium. We've seen the market take great strides in ongoing premium, pay to 65, pay to 100, annual recurring premium, and lots of different flex pay options 1, 3, 5, 10, 7, 15, 20, pay to 65. It goes on and on, right? So there's tons of flexibility, which makes it easy to hone in on an option that a client may need given their financial situation. The opportunity for 1035 exchanges are there as well, allowing you to sort of find the money and have an easy place to put that money to leverage it for long-term care. So obviously there are other markets that are hot right now and have a lot of action. And there are some markets that, are kind of at a plateau right now or just kind of waking up from being dormant. But I think hybrid long-term care has just always been an extremely active and an extremely competitive market. And that's why it's getting a lot of the attention that it's gotten, not just today, but, in the last, especially 10 years or so, there's just been so much growth across the market. So, got some notes here. I think I've gone over a lot of these items, but I think another really big piece of this is joint survivorship coverage. It's also very, very creative with asset care and nationwide care matters together being in the market, allowing two insureds to enter into a second to die life contract and share the long-term care benefit from that. I think that's also a very creative structure. Again, carriers are not afraid to reprice. It's inherent to being able to compete in the market in a lot of their minds. Let's see what else we have. Yeah, carriers in the hybrid space are just not afraid to pivot, move fast, and offer something that most other carriers or product types are afraid to offer. But I want to speak a little bit from a high level on underwriting for these hybrid plans because I think the underwriting stances of carriers really do run the gamut, right? I mean, um, it's all going to be proportional to how much homework the carrier is doing on the underwriting side when underwriting a prospective insured. Um, that will determine how lenient they can be, right? We have carriers like One America who tend to be quite a bit more lenient than their peers on the underwriting side, but they also have a much more detailed underwriting process that a prospective insured generally has to go through with, exams and lots of medical questions. But because they're taking in a lot of data, they can feel more ability, flexibility to give the benefit of the doubt where they can find it, right? But for many carriers, it's a bit of a double-edged sword. There's not a lot of homework being done compared to, say, traditional long-term care um, by hybrid carriers. And that is specifically for the purpose of creating a very streamlined process where we don't have apps hanging up in underwriting forever where we can help it. And the application process is quick. So that is a client experience sort of move. But the other edge of that sword is that if we're doing less homework, we're taking in less information. Uh, we have to be a little bit more conservative with the information that we have, right? So if we're not taking in a ton of information, I don't have a ton of room to give benefit of the doubt, right? So you can see clients who you may think are a good candidate for hybrid long-term care from an underwriting perspective, get denied, get postponed, whatever it may be. I think it's down to how good your relationship is with your underwriters and how good your pre-qualification is to determine if that client eventually ends up in a good home there. But that's just something to always kind of have caution about. Let me read the chat here. You have comments on New York Life AssetFlex. Pricing seems very competitive, but speaking to your comments, underwriting might not be great. Rhonda, I can only really give kind of generalities, which may not be very satisfying because I haven't worked with AssetFlex very much. Feel free to speak up if you are somebody who's worked with the AssetFlex product, but again, may not completely be the case. But I've noticed with captive insurance companies that underwriting tends to be one of the first buttons pressed for making the product a healthy piece of the portfolio. Generally, underwriting can tend to be tighter for a number of reasons. Like you said, offering competitive pricing, or maybe it's a dividend paying product, whatever it may be. Underwriting is generally one of the levers that's pulled there by these insurance carriers. But has anybody in the crowd um, ever taken a look at New York Life AssetFlex? Have you run into it competitively? Do you have a referral partner who works with it? Anybody have any experience with that product that might be able to help Rhonda out? I can take a look into our product information as well, just to see um, if we have any information on it that I can pull up. Doesn't look like we have much here. Your New York Life agent sends all long-term care folks to you. Is he still? Because if he is still, um, I wonder if that's out of not liking AssetFlex or maybe sending you a specific type of client that might not be a fit.
I'm happy with it.
That's all that matters, right? At the end of the day. Um, let's see. Robert says a little bit of an off question, but aimed at the hybrid products. Do we do we feel like they're pricing the products well still, thinking about the expansion of benefits and the past traditional long-term care pricing troubles because they are working on grabbing the market segments? Yeah, I always think a healthy bit of skepticism is important. I think, especially when it comes to, guaranteed premiums, right? A lot of the premiums are guaranteed or instantly paid up. So it's definitely something to think about. I don't know how available Mark is, but having an actuary friend weigh in on this one would be really good, but also interested in what everybody else out there thinks. Um, you know, I think at the it's really going to vary carrier to carrier and what they're offering in exchange for these premiums. But in many cases, having the premium all paid up front is definitely something that is helpful to these carriers. They're not, say, in single pay cases giving out a waiver of premium 5 to 10 years into a contract and then having to pay out claims dollars for years and years and years in those single pay situations. But that being said, we have seen a rise in ongoing premiums or recurring premiums with hybrid long-term care. So I'm interested in what you guys think. Do you take issue with the way that hybrid long-term care products are priced? Do you think they're right in the pocket, right in the sweet spot? Do you feel like maybe we're getting a little bit too much benefit for the premiums paid, or maybe the opposite side of the spectrum? I'd be really interested to hear from you all on what you think. And it can vary carrier to carrier. So if there's a specific carrier where you're like, these guys are completely going off the rails, I think if anybody were to kind of speak up regarding one carrier, I would say what Robert just put in the chat, Bright House. Bright House seems to be that's like kind of their main area of competition is showing up to presentations, and our pricing cells are cleaning everybody out. So I'd be interested in the thoughts on Bright House, especially given that they have a lot of really nice benefits too. There's some really interesting underwriting sweet spots that you can find with Bright House. So Bright House might be the one where I would expect many people to speak up about. But at the end of the day, would love to hear from you all. Yeah, any other questions, comments at this point right now before I walk through a
Yeah,
couple of notes?
Jason, just real quick, since
Yeah,
I'm kind of, new in this space,
yeah,
sort of,
go for it.
what we're talking about when these things have been brought up, Bright House or the New York Life, is that uh, similar to the bridge by Equitrust, like these products where you put in $100,000 and then in 15 years, if you need it, you'll have 300 perhaps $1,000 for care or whatnot. Is that
So these are similar but not similar. You could both consider them hybrid plans. The Equitrust Bridge is like an annuity hybrid long-term
yes,
care.
yeah,
We're looking
yeah,
at life hybrid long-term care, and they
like the one,
function.
okay, like the One America or
Yeah, One America is in that category. They
okay,
function a little differently from annuity hybrid plans. Number one being on a completely different chassis. I think the way these products are kind of sold and understood is live, die, or quit, right? It's designed to have a death benefit there if you don't need long-term care. There's pretty rich long-term care benefits in these plans, and they're long-term care forward first and foremost if you need it. And then there's generally either cash value or some sort of return of premium provision if you want to walk away from the contract and realize some of your value back.
Understood. Thank you. Yep.
Of course.
Mhm.
Diane, do you have something to add there?
Sure. Well, as you were asking about the pricing and stuff, is it feasible? When I look at quotes and run quotes for clients, I find out what they qualify for, and I'll do a side by side of all the companies. And what I see when they're side by side is the amount of money you're buying and the amount of premium that you're paying is not that much different company to company. You know, if it's $800 a month for 10 years with Nationwide, it might be $792 a month for 10 years with Securian. It's not enough different to make a difference. So because they're priced so similarly, that tells me that they're all pretty close on what they're considering the risk to be. So there's
Right.
not one that stands out further than the other. The Bright House, we're going to see a little bit off because they don't have, it's not whole life, right? It's universal life. So they don't guarantee the cash value, they guarantee the return of premium. So we're going to see a little bit of an advantage on premium there sometimes, depending on the age and the state. But they're not, if you look at them side by side, none of them are really that much different if you're looking at the same variables. So they probably have it figured out pretty strong.
Yeah, you make a good point there that there is not a carrier that is essentially like running away with it in many cases. Whether they would claim to be very competitive in every single cell or the best in class and, the industry leading amount of cells, at the end of the day, we don't see a carrier that's like 15%, cheaper than any option out there, all things being equal. Right. And
Right.
when we talk about there being a lot of competition and carriers kind of looking to be among or at the cheapest in the market in certain areas, it's by a fraction of a percent generally.
Mhm.
But we still do see, repricing downward in order to kind of get to that if they find they're lagging in certain cells. Or
Mhm.
they'll come out and say, like when you have a wholesaler visit, for 65 to 68-year-old women, we got 3% better, right?
Go get them.
Yeah, right.
Go
Right.
find one. Yeah.
Sort by age in your book and call them all.
Yeah. So it really comes down to the niche. What is each company offering that's different? And whatever the client is most attracted to is the best plan.
Yep. 100%. And, if you can't beat them, join them too. That's like the nature of the competition a lot. Well, Securian takes a look next door and says, I really like Nationwide's elimination period payback, where they'll essentially reimburse you for the elimination period once satisfied. I think I'm going to add that. Or, most predominantly, I've seen, I see that companies offering full international benefits. I think I'm going to do that. There's a lot of monkey see, monkey do, but it's like we said, you compare on pricing, all things being equal, right? So a lot of times carriers are fighting for, well, if I can't, if I can't be the cheapest in town or the one of three cheapest, I'm at least going to be all things being equal and try to figure out my own way to stand out, right? And it's not even just in the nature of how do I make this stand out to clients. We're seeing products that are also saying, how can I stand out to a distribution channel that maybe feels unrepresented, right? So we're seeing index products enter the market. We're seeing products like MoneyGuard Market Advantage enter the market, Bright House being one of the popular index products. And just when you kind of look inside the mind of a carrier who creates a product like that, a lot of the times it's saying like financial advisors need to be doing more long-term care planning with their clients. And if we can put out a product that's palatable to them, that, can really speak to their strengths, that we know they're going to sink their teeth into and gravitate toward and understand well and be able to present with authority. Because, many advisors, when they're dealing with long-term care products, you know, tend to say, maybe it's just easier if I tell my client to self-fund, or, you know, I have a problem closing long-term care products versus, you know, selling securities or ETFs or whatever it may be. But an index product kind of pulls things more into the area of their expertise. And as long as they kind of know the basics of long-term care planning, that will get more distribution to ideal clients. Right. So that's a really interesting play that I see as well. That's only afforded to, you know, uh, life plans with long-term care or annuity plans with long-term care, right? Even bridge on the index side in the annuity space. Uh, Gail said pricing's also affected by the market the carrier is catering to, age or partners or reimbursement for. Exactly. Yeah. So there's just a lot of ability to be flexible because of the way the products are constructed, are built. And we're just going to continue to see them kind of take advantage of that. But updates, just quick product updates. Definitely feel free to keep the conversation going in the chat. All right, we'll keep the conversation going in the chat. Robert says, do you feel something like the One America or Lincoln AOB 2-year reduced benefit but cash catering to the dementia risk? Could you unmute and just add a little color to that? I just want to get a better sense of what you're asking.
Yeah, of course. So One America specifically, like, you know, they have the reduced amount of benefit available in the first 2 years of acceleration.
Ah, yes.
But in most cases, what I see just like is that the first 2 years is sometimes that's a lot of home care. So then it's catered back that way to the dementia risk with the like lifetime benefit availability, specifically with like One America. But the Lincoln has that reduced cash benefit option too. So I was just wondering if you think there's like specific markets of risk they're targeting, or
Yeah, it's an interesting question, and there's like a lot to unpack in answering it. I think when you can take a smaller portion of the monthly benefit that you're generally allowed under the contract in cash, I think the carrier in many cases wants you to take that because at the end of the day, they're on the hook for less benefit overall. So I think that's something that you know, a carrier would market as mutually beneficial. And in many cases, it can be, right? If you get flexibility as the client and you can stay at home or reimburse an unskilled caregiver, I think there are situations where you'd sign up for that. But it's also good for the carrier in the sense that I know I don't have to pay out the full monthly benefit to this client because it's a one or the other proposition to take that reduced cash benefit, right? And overall, from the long term, that reduces the chances that you're going to use your entire benefit. So I think there's things working for both sides with that. But I do think One America is kind of an interesting case study around your question anyway, because a critique of One America's plan and one of the ways they've kind of historically been able to save themselves some overexposure is by either not offering inflation protection on the base plan in certain cases or offering a very expensive inflation protection on that base plan. And you need to get through the base plan before you get to that EOB, which contains all of the, you know, really nicely priced inflation protection, the options for lifetime unlimited benefit, right? So as one of my long-term care specialist friends at my old BGA used to say in conversations, you kind of have to get through the browner pastures before you get to the green pastures of the EOB. I think that's an intentional product design. It allows them to kind of be able to offer lifetime unlimited benefit in any capacity and feel good about it. Yeah, it kind of helps to support their ability to kind of take on that risk of, you know, a cognitive claim where they're on lifetime benefit and they're going to be paying out claims for a very, very long time. Gail says reimbursed benefits versus cash indemnity tend to be less costly. One actuary I worked with years ago commented that product managers try to differentiate from other products, said it's really all about the distribution at the end of the day. I agree. If you can catch the eye of distribution, and what do we care about as distribution, guys? We care about being able to offer really great benefits. We also care and should probably care more that we're offering cost-effective solutions as well, and the market is kind of rising to the occasion as well, offering us, solutions that are a bit more affordable or manageable on a recurring pay sort of basis. But we're interested in offering benefits that work for our clients, and both distribution and insurance carriers are kind of tied together in the fact that we sell promises, and the insurance companies need to keep their promises, and we need to properly represent and hold those carriers accountable for the promises being sold. So yeah, I think it's about attracting distribution and attracting clients, right? If you don't get the eye of distribution, your product's not going to be, promoted to anybody at the end of the day. Yeah, I love this conversation. Robert, I don't know if I understood. If you wanna unmute and
Just a comment on what you're commenting. Nothing to add.
Okay. Okay, gotcha. Yeah, I think yep, at the end of the day you have to impress distribution. So if it's on a pricing spreadsheet, or it's I offer this benefit that I think your clients will really enjoy, and I think you will love to bring this up in a presentation, that's what matters. And you see a lot of competition with that in the hybrid space. Just a couple updates. We went over it in a previous study group last week. But remember, we have Secure Care 4 enhancements with no pricing changes. Pretty crazy. Death benefit will at least be equal to the premium paid at all ages. They added a 20 pay option. They changed their international benefits, enhanced their international benefits, 100% of benefits internationally. 90-day elimination period payback. Yeah, just lots of really, really good additional product features there. Anything else that was in hybrid long-term care? Anybody else see any interesting news coming out of the hybrid space that I may have missed? We had a lot of well-rounded information, but Securian was kind of the major one. I mean, it's been a while since it's been out, obviously, but I think the last new news we heard from One America was Asset Care 2024, with a lot of interesting enhancements there. Nationwide's been kind of focusing on the release of their new annuity. But yeah, I would say maybe the quietest that I've seen the hybrid long-term care market, and it hasn't really been all that quiet at the end of the day. I could take a look at some underwriting sweet spots for you all. Has anybody seen any interesting underwriting pockets in the hybrid long-term care market to this point? I did mention Bright House. And Bright House is interesting, just kind of like One America, that they can, table rate folks. So they can go up to 8 tables for mortality risk. One America can go up to 8 morbidity mortality. Chris says One America in Texas had a good training session today. That's good. Anything interesting that you learned? Feel free to let me know. Underwriting. Bright House can be friendly toward things like cortisone shots, as long as they don't affect activities of daily living. They're friendly towards some cardiac conditions, very specifically anxiety and depression. Relatively liberal build chart for their underwriting. So those are some of the things that I see from Bright House. One America, I would say you can expect the same there. Expect to see a very liberal bill chart for their underwriting as well. I am going to check into what else I have here in.
Hey, Jason, again, I'm sorry. These are
Yes,
all
sir.
plans then that you are paying like on a monthly basis typically and has nothing to do with qualified or non-qualified funds. Is that right?
There is only one product on the market with One America that is like specifically set up to be able to receive qualified funds.
Correct.
Um, that's kind of one of their big sort of differentiators. But when we talk about like non-qualified premium to these hybrid long-term care carriers and products, you can see an ongoing premium. You can see things like pay to 65. You can see things like pay to 100. You can see single pay is most common and is going to result in the best leverage. If you give the carrier all the premium up front, you're going to get kind of better leverage in exchange for that. But you can also see things like 10 pays. You can see 3 pay, 5 pay, 7 pay. You can see 20 pays. There's a lot of flexibility, and that's one of the big descriptors I use for hybrid long-term care is flexibility in premium, and in all things really. At the end of the day, carriers are not afraid to be flexible in this market. Let me see. What else did I have for Bright House? Bright House's kind of simplified underwriting process for clients under 65, I find really good. And excuse me, it's 8 tables for morbidity with Bright House, 4 tables for mortality is what I have here. Family history was another thing for Bright House, and I think which one of the things that makes people kind of go, ugh. Family history is generally not considered or part of their underwriting questions for smart care. Recreational marijuana use is also fine with smart care, so that can be kind of a sweet spot more nowadays than ever with legalization in a lot of states. So if it's causing a social or occupational issue resulting in loss of employment or psychiatric issues, obviously they're not going to look at it, but no residuals, kind of normal recreational use is okay with Bright House. Recently completed physical therapy is also something that they'll look at. So Bright House can, in many cases, consider immediately upon completion of PT. So there's a lot that they're doing for kind of cases that are postponed elsewhere where they're trying to get some of those folks in and underwritten, which is interesting. Let's see. Yeah, we're seeing annuity long-term care plans like really heating up, and I think you nailed it, Gail. For the older ages, they tend to look a lot more favorable than hybrid life long-term care plans. Many times when you see yourself getting into the upper 60s or lower 70s with a client, you can, start to see the plans get a little bit heavy. They start to sink a little bit, and that's where you want to compare both products, both product types for those in that age group. But at the end of the day, I think annuities can tend to look more favorable there, or starting to look more favorable there. And I just want to give a quick plug to one of our tools on the individual side in the buddy system. For those of you who haven't seen it, if you're in the buddy system, you can click on individual and go to product buddy. And this can help you kind of get some presentation materials, but also kind of filter out some carrier and product type options. So if you have the client's age, if you have their state, we'll just use Kansas. If you have a general assessment of their health, obviously don't put excellent unless you know absolutely it's excellent health. Most people, because it is average, will end up in average health, right? And you can put in kind of your preferred funding for pay as you go, single pay, limited pay. And essentially based on what you enter, we will recommend different product types. And you can see Life plus LTCi extension is essentially the products we're talking about here. You can get some recommended carriers and you can get some highlights for the product, but you can also come up with these one pagers that you can download that will basically give you a lot of the specs that we're talking about today. Like, who are the ideal clients for hybrid life and long-term care? So with respect to age group and what is kind of the overall market range, what's the lowest age? We could look at this at what is the highest? What's the preferred funding of kind of the ideal candidate? What are their goals, right? Generally, this is repositioning a small piece of your assets to protect the rest as best you can, right? And just again, what do the ideal clients look like, and why do we look at hybrid long-term care from a client perspective, right? Talking about that versatility of the live, die, or quit, talking about the strength of cash indemnity benefits that are prevalent with hybrid long-term care plans. Many have streamlined underwriting. We talked about the premium flexibility. Beyond joint survivorship with partners, we also see a lot of couples discounts, right, with hybrid long-term care plans. And of course, last but not least, inflation growth can be very, budget friendly for many, or, won't completely break the bank to add inflation protection to many of these plans. So that's a one pager you can leave behind with a client just to remind them, what's the importance of the hybrid plans we talked about, like what are the big key features. So I think that's about all I had planned. Does anybody have anything else that they want to discuss, ask a question about, put their 2 cents in on hybrid long-term care before we wrap up the study hall today? Marketing ideas. Okay. Gretchen, write that down. We got to put a study group session together for marketing ideas. You are requested.
Thank you, Chris. You get a gold star for today.
Rate increases with Mutual of Omaha. Gail, what'd you hear there? Oh, I've got you on mute if you're trying to. You're on mute, Gail, if you tried to.
Well, I just feel that it's the one carrier that I was really hoping would hold out. So, because they really dealt with, when they did the 2021 or 2022 product, and when they repriced it, changed the discounts, but it wasn't presented as a rate increase. It was just, I always say, smaller portions at the restaurant. So they had to do that, but I'm just getting deluged. I don't know if anybody else is and how much they sold Mutual of Omaha, but the way the carrier actually communicated with the client was very convoluted, not clear, not dated, and it's really turned into a lot of work on our end, which I don't mind doing, but a lot of this is just how the carrier handled the communication. And also, I just was not expecting this kind of rate increase with Mutual Omaha.
Yeah, because they were pretty rock steady for a long time. Not really. It was kind of no news is good news for the longest with them. Was this on the 2013 product generation? Or earlier?
It was, yeah. I mean, when they were issued, they were be like 2013, 14, 15. But, the people who bought it after 2020 just did not get as rich of a plan as, as the people prior to that time. So,
gotcha. I'll
It
keep
never
my ear to the
helps.
ground on that.
The
And
rate increases never help the
yeah,
industry.
agreed. It always creates, you know,
Now-
stigmas.
Can I ask a question? Since I spent many a year in the property casualty field, do rate increases for someone, Gail, for instance, that you sold a plan to in 2005, do they have increases or do they just cut their benefit for them?
They're not built in rate increases like
Yeah.
other products may assume.
Yeah.
Rate increases like throughout the life of the contract or yearly or at certain age bands. It's basically premiums are designed and assumed to remain level. But if there is any sort of, um, you know, petition to
Dean, I'm
a
online right now. You can't make
a
the
state
noise.
insurance, if there's any petition to a state insurance organization that says, you know, the insurance commission that says, here's substantial proof that, you
The
know,
ship's gone down.
the ratio of benefits paid to premiums taken in is out of whack. They can petition for a rate increase and can be approved or denied by the state insurance commission. Most of the time approved if they're showing, you know, credible evidence.
But they also can go over to, like, say, a period of time. I remember with MetLife when they had huge rate increases here in Illinois, specifically since I was a policyholder, I felt it. And, you know, they were going to do it. Oh, if they negotiate, the Department of Insurance often will somewhat negotiate with the carrier how they're going to spread this rate increase. And it's usually over time. So, you know, the question, I don't know if anybody else in the group gets this often is, you know, when will there be another rate increase? And, you know, we say, well, we don't know. We tell them why, but it just, I think that it's so important for the carrier to do a better job or a good job of explaining the choices, the outcomes. Some do it fabulous, and I'm really disappointed with Mutual of Omaha, how they handled it.
Thanks for sharing that. And Paul, just for your information, that's one of the benefits of the hybrid long-term care products we're talking
Thank
about
you.
today is
That's
that
what
we
I
have
was trying to get to my
guaranteed
brain.
premiums.
Yeah.
With traditional long-term care,
Yeah.
you know, designed to remain level, but certainly not guaranteed to remain level.
So so the ones that you're talking about today, which are the hybrid sort of chassis on a life insurance policy, they will pay the benefit that was promised at the inception of the plan. Or no?
I'm sorry, what was that? I was reading the chat. Sorry.
Yeah, that's okay. I knew your mind was elsewhere. No, so plans that are purchased today under the chassis that you're talking about, the hybrid chassis, say the One America life insurance / long-term care, they will pay what they're saying they're going to pay, or even they are suspect to review and change 20 years in the future.
Well, the premiums are guaranteed in many cases with these plans.
The benefits, yeah. That's
so, yeah, a rate increase is generally implying for the same benefits you will have to pay more, or you'll have to reduce benefits to retain the premium that you were paying before the increase, right?
Correct.
With the hybrid plans, the premiums are either, you know, completely guaranteed throughout the life of the contract or are paid up in one shot, thereby meaning you can't increase the premium when I've fully paid it up, or it's paid in a window of 10 years. Generally, we see these premiums as fully guaranteed. So the premium you pay year one is the same as the premium you pay when you fully paid.
And in 20 years, when the person knocks on the door and says, I have a claim to make, that amount that Gail told them 20 years ago will hold true.
Yes.
Okay.
Even even in a case of rate increases, the carrier still has to keep their promise. That is part of how you even get a rate increase, right? Approved at the end of the day is to, you know, you're going to stay in business. You're servicing your policyholders. You're keeping your promises. In very few cases has a carrier, you know, completely found themselves insolvent. And there's even protections beyond that, where each state has a guarantee fund that guarantees people a certain pool of long-term care benefits if the company went completely insolvent. So there are a lot of protections in place, and again, the traditional long-term care products, by those who know what they're doing, are not sold as guaranteed premiums at the end of the day. But there are lots of protections in place, and these rate increases don't get approved if a carrier just because a carrier wakes up one day and says, I got to make more money on this.
Yeah. But
right.
in other words, in the old days, it was kind of like car insurance. You paid so much and you thought that was going to be it, but then they said, no, we're having an increase.
Right. Yeah, and we'll do a session on rate increases here coming up soon. I generally try to do one a year, and
okay,
usually there is some good information that comes out of it, but there are many who get rate increases. It's because they've had an excellent value in their plan for a very long time and have, owned an underpriced plan for a very long time. The older the plan is, it essentially looks more and more like a gold mine tax, but generally what you would pay after an increase is generally less than what it would cost to be new business on the market today by a long shot. So hope that helps. Yep. But yeah, appreciate everybody being here today. Thank you for the discussion, your questions, your comments. We'll do study hall sessions periodically on each of the product types throughout the year. We just thought we'd get it started with hybrid long-term care today. And we look forward to seeing you next week. Same time, same place. See y'all.